Let's talk about gold. Everybody wants it, but the way we invest in it is going through a massive change. So forget about picturing dusty safes or heavy gold bars. Today, we're jumping right into the digital showdown. Gold ETFs versus gold mutual funds. We're going to figure out the smartest, easiest way to own gold without ever having to touch it. Let's do this.
You know, you probably think that gold coin you have stashed away or maybe that piece of jewelry is the safest investment you own. I mean, it makes sense, right? You can hold it, you can see it. But what if I told you that the very thing that makes it feel safe, its physical form, is actually its biggest weakness? We're about to dive into the hidden risks that you might be totally ignoring.
So before we get to the modern solution, we have to really understand the problem. Owning actual physical gold comes with some very real and often pretty expensive headaches that most people just don't think about.
I mean, first, you've got the obvious one, theft. It's a constant worry. Then you have to figure out where to store it securely. And trust me, a good locker or a safe isn't free. And here's the kicker, especially with jewelry. You get hit with what are called making charges. That's the extra money you pay for the design and the craftsmanship, and you never, ever get that money back when you sell.
Ouch.
And that is exactly where digital gold swoops in to save the day. It's this brilliant way to invest in pure gold through your brokerage account, and it just cuts out all those physical problems we just talked about. It's simpler, it's safer, and it's way more efficient.
Now, in the digital gold arena, you've got two main fighters. In one corner, you have gold ETFs, which trade just like stocks. And in the other corner, you have gold mutual funds. They might sound kind of similar, but how they actually work, and more importantly, the risks you need to know about, are totally different. This is where the real showdown begins.
All right, let's start with our first contender, the gold ETF. Now, for anyone who's already comfortable buying and selling on the stock market, this is usually the first thing they look at.
So what is a gold ETF really? Well, think of it just like a share of any company. You buy it and sell it on the stock exchange. But here's the cool part. Every single unit you buy actually represents a tiny little piece of real physical gold that a fund has already bought and is storing away in some ultra-secure vault. So you get all the benefits of gold's value with none of the hassle. Okay, hold on. Before you even think about buying a gold ETF, you absolutely have to understand this next part. Seriously, ignoring these next two risks is the single fastest way for a new investor to lose money. This is where so many people go wrong. The first huge risk is something called poor liquidity. Now, liquidity is just a fancy Wall Street term for how easy it is to sell something without taking a big hit on the price. If an ETF has low liquidity, it means not many people are trading it, and that can be a massive trap. And this is where it gets scary. Picture this, the price of gold is shooting up and you decide, okay, time to sell and take my profit. But if there aren't enough buyers on the other side, you're stuck. You literally can't sell. You might have to drastically lower your price just to find someone, anyone, to buy it, turning what should have been a nice profit into a painful loss. So how do you avoid this nightmare scenario? Here is the most important rule. Write this down. Only even consider buying a gold ETF that has a daily trading volume of at least 1 million units. That number, 1 million, is your proof that there's a healthy market so you can actually get out when you want to. All right, the second risk is a little more technical, but it's just as critical. It's called the INAV premium. Now, INAV stands for Intraday Net Asset Value, and it's a number you absolutely must check before you hit that buy button. Think of the INAV as the true or fair price for one unit of that gold ETF at any moment during the day. Since ETFs trade like stocks, their market price can sometimes drift away from that fair price. And if you buy when the market price is way higher than the INAV, you're literally just overpaying for your gold. You have to check it.
Okay, so if all that talk about liquidity and trading volumes and INAV just made your head spin, you're not alone. And that is precisely why we have our second contender, which is designed to be the set it and forget it alternative, the gold mutual fund.
And this is its superpower, simplicity. With a gold mutual fund, you don't need to check trading volumes. You don't have to worry about INAV premiums. The fund manager does all of that complicated stuff for you. Your only job is to invest.
This table just puts it all in black and white. It couldn't be clearer. Look at the difference. With an ETF, the responsibility is all on you to check for liquidity, to check for a fair price. It's an active, hands-on game. But with a mutual fund, all that work is gone. It is built from the ground up for passive, hands-off investing, like with a systematic investment plan or SIP.
So after that head-to-head battle, which one comes out on top? Well,
For a certain kind of investor, and I suspect that's most of us, the choice becomes incredibly obvious. Let's lay out the winning strategy.
So look, if you are a long-term passive investor, someone who just wants to build wealth over time and doesn't want to be glued to a screen tracking market data all day, then the gold mutual fund is, without a doubt, the better choice for you.
And you know what the best part is? The barrier to entry is incredibly low. You don't need a pile of cash to get started. You can start a systematic investment plan, that SIP we mentioned, with as little as 1,000 rupees a month. You just slowly and steadily build your gold position over time. It's that easy.
This really sums it all up perfectly. The whole point for most of us is to benefit when gold prices climb. A gold mutual fund gives you that smoother ride. It lets you capture that upside without all the stress and the technical headaches of trying to actively trade an ETF. So, there you have it. We've broken down the risks of physical gold, we've navigated the digital showdown, and for the passive investor, the path forward is pretty clear. So the only real question left is, what's your next move?